Hi, happy weekend. My name is Loutsenko. I am, excuse me, head of research and CEO, and I guess founder of OVMO Research. So like I said in my first video, before I introduce kind of some of the more specific details about OVMO research, I wanted to do three videos. So I shared my economic outlook last week. I want to share my US equity market outlook, and then a third video that'll probably be a bit longer, sharing my global macro outlook. Like I said, I wanted to talk about the equity market today, and hopefully it won't take up too much time as the last video. I think broadly speaking, for the US equity market, I guess, really, I'm going to be looking at the S&P 500 and also with, a few of my thoughts about the Russell 2000 at the end. But by and large, I think, just kind of summarize where I think we are. I think, we're at the late stages of kind of a secular equity market, and um, kind of goes along with our expectation that the lagged impact of rate hikes will adversely impact the economy in a more severe way than consensus is currently looking at it in the second half of 2024, which will ultimately cause a downturn or recession in the US economy. So, um, I guess I'll start the presentation here. So really probably two-thirds of it is very specific to the US equity market, but I started off with a couple of macro slides, just because quite frankly, my personal opinion is, macro is knowing macro and understanding how it impacts the equity market is, pretty essential to being successful in the market today. But from our perspective, we tend to look at, macro data, macro indicators, excuse me, pretty commonly in our broader equity market analysis. So get going. Wait, share. Okay. So the first slide here, thought this was interesting. So kind of also gave me a little bit of a sense of why the New York and San Francisco Fed have been um, so much more willing to use the 10-year 3-month yields curve spread this cycle, whereas in the past it's been the 10-year 2-year pretty commonly. So here we see 9 different inversions for the 10-year 3-month yields curve since 1927. And what this really interestingly shows is that there's a pretty high correlation between the time, the duration in days that the 10-year 3-month yield curve stays inverted, and the S&P 500 cycle peak drawdown, which here I measured peak to trough. So to the right is going to be the cycles where the yield curve stayed inverted for longer, and you can see that corresponds, know, pretty pretty accurately to a more severe drawdown for the S&P 500. I think that's important to start off with, I guess for two reasons. So, number one, this cycle is now right on the heels of 1974 in terms of days of inversion, and right after that, it'll surpass 2008. So, we only have the one preceding the Great Depression to look at after that, and that's pretty depressing, no pun intended. But also, I think just the second part, I kind of wanted to reintroduce the whole notion that, we could still very much have a recession, because it seems like it seems kind of like a foregone conclusion that, consensus isn't even really um you know evaluating the possibility of what a recession could do, and to various risk assets. But nonetheless, basically the takeaway here is the longer the yields curve stays inverted, the harder the landing is for the S&P 500. And in this cycle, if history repeats, we're looking at a very, very substantial drawdown that, I've been saying it for a while. I don't think investors are, really even acutely um, prepared for, you know, even the possibilities. But moving on. So, rightfully so, many have been pointing to initial jobless claims in this cycle, which have been very muted, as confirmation of the U.S. labor market's resilience. And again, I wouldn't discount that for sure. This chart actually curiously, well, at least somewhat curiously to me, finds that initial jobless claims, at least going back these 4 or 5 cycles, they only really begin to materially start rising after the 10-year 3-month yield curve starts steepening. And recently it just did from about 100 negative 130 degrees to about 82 degrees inverted. But it's still pretty significantly inverted. Even that inversion level is the deepest since the early 1980s double dip recessions. And you could see at the peak, at the trough, it was almost 200% inverted on the weekly here. So we talk about this all the time. Monetary policy lag times vary, and I don't necessarily think that the duration of the yields curve inversion is indicative of how soon we should expect initial claims to start rising. I think in this cycle, we're actually seeing labor market deterioration in other places, which I'll touch on briefly. But yeah, just some food for thought. So here's something that's very unusual and unique to this cycle with respect to US labor, and also, quite frankly, extremely concerning. So the first thing to note is each tenth of a decimal point in the y-axis is a million people, up or down. So right now, US full-time employment is at about negative 1.4 million US workers on a year-over-year basis. So let's look back, what is this, 8 cycles or so, going back to pre-1970. In every, recession we see, and we pretty much never see full-time employment decrease on a year-over-year basis outside recession. But we see full-time employment start to contract in a meaningful way, either, towards the later part of the, official recession, or knee deep in the recession. There's not one cycle here where we see full-time employment begin to, contract. And again, this meaningfully before the recession begins. Typically, we would expect temporary employment, which is a leading indicator in labor, to start to roll over, before the labor market weakness kind of broadens out. And we have seen, or at least, we did for a while, we saw part-time work, or temporary workers in a downhill trend. But again, when it comes to US labor market weakness, yes, initial claims have been very reliable since, the mid 1960s. But my sense is there's a lot of labor market weakness not uncovered under the hood when you're just kind of looking at a, muted initial jobless claims number and a historically suppressed unemployment rate and calling it a day. It's just, more data going back to that point that actually maybe maybe this is a good time to bring up something else. So um when we talk about or when you hear in financial media that the US recession has been wildly delayed or avoided altogether, which I don't understand the logic to something being avoided just because it's been delayed, but that's another story. Um, when you really look at the macro data from prior Fed hiking cycles or yield or cycles where the yields curve inverted, we don't typically we we don't typically see labor market deterioration begin until 2 years after the first Fed hike. That's the people use different metrics. Some like to look at an interval from the last hike. I think, historically the most accurate way to time, of course, give or take a few months here, potentially longer due to the labor market shortage. But taking an interval of about 2 years after the Fed's first hike is when we should start to see deterioration in labor, not labor in recession. So this chart makes a good argument that we're getting there because as you could see, the first Fed hike was in March 2022. March 2024 would be 2 years from then. And here we see from 4Q23 to 1Q24, permanent job cuts are increasing substantially on a quarterly basis. And, that's how, historic monetary policy lag works. And if history is a guide, it would start working at an accelerated rate after it kind of initially, makes material contact with the economy, if that makes sense. So, just to, excuse me, two kind of interesting charts here that, really the bottom line for both of them is they're a measure to suggest that U.S. equity, and specifically U.S. growth large cap stocks are disconnected from the economic reality in the labor market. Here, you could see the jolts on non-farm payrolls that reliably start moving in a downward trend into recession, and it's disconnected from the S&P 500 today for the first time in 22, 23 years. And on top of that, in this cycle, we haven't hit recession yet, but we can clearly see that the jolts non-farm payroll numbers are moving in a downward direction, which, you know, I mean, it looks almost even more recessionary than the GFC. So again, from my perspective, initial jobless claims and the lagging unemployment rate really don't tell the full picture in labor. So here's the second chart. I've shared this a few times. So the pinkish line is the S&P 500 year over year percentage price change, and the brown line is ISM new orders. So we could see a solid correlation here going back 75 years. ISM new orders the last month had a very positive surprise to the upside. I don't see that holding given the rate environment from the Fed, but nonetheless, even now in expansionary territory for the time being, they're still disconnected from US large cap equity prices, the S&P 500. So again, just two charts to kind of drive home the point that um, equity valuations and equity returns, kind of what's happening in the equity market, is pretty disconnected from, I would say, the U.S. economic reality. Okay, so now we could just stick to the U.S. equity market specifically. So I put this out at the start of February, excuse me, start of April. And this is just the S&P 500 segments with the weekly, monthly, et cetera, performance. And then our segment weightings, again, as of April 2024. So I think I'll just go down to high level and explain our rationale. Really, it's calculated based off Z-scores, so it's more quantitative. But we also have some qualitative views as to how we arrived at those positions. So, information technology. First of all, the ETF is think about now it's under with Nvidia, but it's almost 40% Apple and Microsoft. Apple, we're seeing it more aggressively this year with demand in China, but in my view, Apple's already shown very un-Apple-like weakness the past year and a half with year over year revenue losses and or revenue and earnings for 4 consecutive quarters. Hasn't happened since the iPhone came out. And we see additional, it's a longer discussion, but we see additional headwinds to Apple moving forward. I think I look at it as more of a consumer cyclical, honestly, than I do an IT stock right now, especially with their lack of participation in, the AI developments. But, as far as AI goes, NVIDIA's been doing great. There's, no one can deny that. I think pretty much anyone who's looked into semiconductor stocks over a longer period of time would, pretty quickly agree that they have very cyclical fundamentals. And I believe that will apply to NVIDIA in, not sure I would say the near term, but you have Mag 7 competitors now building out their own GPU capabilities. So that's going to take a lot of market share from NVIDIA, not even withstanding the cyclical fundamentals part. So in the long run, we believe NVIDIA is overpriced. We're not confident in Apple, and we're skeptical of Microsoft. Microsoft's valuations kind of ballooning. It's close to 40 price to earnings, which for Microsoft is actually quite steep relative to history. Communications, we were overweight. We've held that position since the beginning of the year, and it's paid off. It's been the best performing segment of all 11 heading into the 2Q24. I think there are a few slides, the next couple slides that I think will help explain more why we went overweight in communications. Underweight consumer discretionary. We do not like highly cyclical businesses with that tend to have excessive valuations based on future growth expectations, when in the deflationary macro regime that we're currently in, we don't expect them to be realized first. And we're seeing that front and center with Tesla. We're seeing that with Nike. You can kind of go down the list. So We thought it would be appropriate to fade cyclicals, to be quite honest, in fourth quarter of last year. So we have pretty high conviction in that. Neutral for healthcare. It's a growth sector. It's been underperforming for sure. Recently, United Health had a very good earnings quarter. Eli Lilly's been doing tremendous, even though it's still not a huge part of that ETF. But we don't mind the valuations. We think it could perform okay if we do get economic disappointment. Energy, we're underweight because we think this is always subject to change based on geopolitical risks. Obviously the most eye-popping one right now is Iran, Israel. But we feel the supply is there. It's really the demand story. In deflationary environment, we would expect demand to decrease and continue decreasing as the lagged impact of rate hikes continue to set into the economy. We were above average materials because, as we'll elaborate more in our macro presentation, the third video, we're quite bullish on precious metals specifically and some other commodities. Materials is really the only way to get exposure to that in the S&P 500. We've Newmont Corp comprises about 4.5% of the ETF. Excuse me, Lind is the leader in that one by far, controlling like 21 or 22, and they've been doing well. They've been up 21% year to date. So we feel okay about materials and the outlook moving forward. Neutral on industrial is kind of the same explanation as for healthcare. Underweight in financials. So financials have really been outperforming. They came into April second out of 11, right behind communications. Bank earnings earlier this week. I mean, I guess it depends who you ask, but I heard a lot of people saying positive things. The market didn't react that well, by and large. JP Morgan sold off. But our bigger concern here is the ongoing banking crisis that seems to come up in conversation every so often, literally when there's an insolvency, and that's when it's too late to start talking about it. So we believe that there's further potential for adverse contagion in large cap financials. Based on that, and also I think falling rates will be a headwind for some of the businesses that large cap financials have. Consumer staples, so we're neutral on this now. We would move to above average once rates started to cut. Our research shows that consumer staples and utilities are in the S&P 500 are by far the most two interest rate sensitive segments. Utilities were overweight on because we really like the valuation, and there's a little bit more of a story there other than just interest rate sensitivity. But for consumer staples, that's definitely how we're going to play it. We're going to remain neutral, and then once rate cuts begin to come in, if we see economic disappointment for sure, then I'd say we'd upgrade our rating there. And lastly, real estate, definitely underweight. It's been underperforming, and kind of with good reason. Earnings have been bad. Just bottom line fundamentals have been bad. 11% of the ETF is controlled by Prologis, which is down something like 17% year, maybe close to 20. It dropped a lot yesterday, but it's again controls, it's by far in first in terms of total weight of that ETF. So, and in addition to a host of other headwinds for that we see for real estate, just one thing I would say on that, because I've gotten a couple questions on it. The XRE ETF and home buyers are actually they're two different ETFs, but you don't have the DR Horton kind of stocks in XRA. So that was an important distinction. I think I'll go pretty quickly through the next few slides, just kind of telling the same story. I actually think I shared this table before. Just one point I want to make about this, I've heard and seen a ton of people that I actually respect, a great deal in terms of their financial market knowledge and experience, and still respect them obviously. But I've heard a lot of them say that basically, any upside for the S&P 500 is, good news this year because the market's priced for recession. And I'd be curious to hear what some of them, might have to say in response. But based on 19 out of 20 very commonly accepted valuation metrics, the S&P 500 is overpriced relative to history. And by some, quite extreme. So I guess my main point I double down on is I'm sorry, I do not see how US large caps are priced for recession or economic disappointment. I think it's the opposite. Just one more visual representation of the Shiller Cape ratio, cyclically adjusted earnings for the S&P 500. I personally favor this to just the common PE ratio because it's cyclically adjusted. So I think it makes more sense in the long term. It's also adjusted for inflation. So it's my 2 cents. But I think it's worth pointing out that 32.61 is an extremely high CAPE ratio relative to history, and it's actually a little bit above the peak preceding the Great Depression, where we saw really horrible deflation. So
That's not nice. By the way, if you have another
I'll just keep going. Series ridiculous. Okay, so the S&P 500 annual and estimates for 2024 and 2025. So the projection is, I believe, 11.6% EPS growth in 2024 and 12.9 or something like that in 2025. That's really, really exuberant expectations. If you look at a lot of the post GFC secular bull market, earnings weren't growing at that pace, not even close. And that's quite substantially above the long-term trend, which from 1932 to I believe 2009, right, or 2008, right before the GFC, was an even 5.5% per year. Granted, since then it's increased, but these earnings estimates are, make no mistake about it, they're pricing in a very, very resilient economy and really, really really, really good execution all around the board in the equity market, which this slide should provide better clarity on. So just the top left, bit of a side note. So profit margins declined in 11 out of 11 segments on a quarterly basis between 4Q23 and 3Q23. So, if you talk to anyone who's followed the market, especially large caps in the S&P 500, what's the first thing the vast majority will do? Begin layoffs, begin trimming costs to get net profit margins up. And we've seen this with Amazon promising, I think, as much as 40,000 workers laid off. Just a couple of days ago, Tesla 15,000. Google is announced that they will announce layoffs. Meta's been doing this virtually nonstop. So that's certainly not good for unemployment prospects in the future, and that could send us into a recession where these earnings growth projections, which I'll go over, will look even more ridiculous than not ridiculous, will look even more wildly unattainable than they do now. So I should have included one for 2023, but you basically would have seen something like this, where you have 6 or 7 segments in the red, and then the minority in green. Here for 2024, we're pricing in across the board sector EPS growth minus energy, with limited amount for materials and real estate, though both are expected to grow. So here again, if we had 2023 to juxtapose, this would have been a very, very aggressive bullish estimate. And absent material rate hikes, plus the lag for those rate hikes to positively impact the economy, I don't see the economic rationale of why we should expect that. And furthermore, look at 2025. I mean, that's what you look for in like the most interesting part of the secular bull market. This is assuming that we get to almost 13% year over year, 12.9%, almost 13% year over year earnings growth in the S&P 500, with an assortment of macro headwinds that could really, not just put that hypothesis in jeopardy, but kind of, I don't want to use wrong language, but kind of kill it, because if you look at all the different possibilities, that would be a bad thing for these earnings estimates to hold up. Inflation reaccelerating, labor deteriorating, potential what we view as a likely recession, problems in overseas and international economies. Geopolitical tension could cause oil prices to spike, and then estimates across the board go down, except for energy. So, and I could keep going on, but point being, not only there are a lot of headwinds that make us cautious about these estimates to begin with. We don't even think they would be realized. We think they would be extremely difficult to realize in a secular bull market environment where the economy is very comfortably growing, sentiment is high, and things like that. So I think this chart is pretty crucial to why, from a quantitative perspective, we decided to go long on communications. So this is the 12-month forward PE, 5-year average PE, and 10-year average PE at the sector level for the S&P 500. You can see at the index level, it's a little bit high very slight, very marginal relative to the 5 and 10 year averages. Communications looks good. And especially with, what else, you have to choose from. Tech is wildly overvalued. And that's again not factoring in uh, what we view as very dangerous macro headwinds. Um, and then also here, you see utilities, great valuation. Um, so again, we we definitely took a quantitative look at it, but we also used qualitative analysis in how we weighted the S&P 500 segments I shared before. So we should be closing in on the end. That's just one example. So Google, Alphabet, Class A and Class C shares control the biggest part of the XLC communications ETF, bigger than Meta. Um, and Microsoft and Apple are neck and neck for the largest in infotech. You could see since 2004, and Microsoft was around well before this. Google has been able to grow their revenue on a yearly basis at a much more impressive rate than Microsoft has. Um, so again, just kind of goes to the argument that we like the fundamentals combined with the outlook in communications. And the final thing I would say about that is, so specific to the environment that I think we're in and likely getting close to, I think it could work out in terms of market leadership, kind of like it did in 2016, 2017, where, sorry, especially in 2016, when there was a lot of bullish sentiment in general about the economy. Sorry, bearish sentiment in general about the economy. And that led to the S&P 500 having a small down year before again recovering and having a few great years after that. But what we saw in that cycle was investors who were kind of unsure about uh, I wouldn't say unsure, perhaps skeptical about US economic strength. They kind of traded into high growth areas of the market, which at that time was largely healthcare made the most sense. But what I want to stress is that we feel that that's appropriate in this environment too, and that's why we chose communications. But it's very important for us to, make the distinction between cyclical growth and non-cyclical growth. So when it comes to cyclical growth, we are, quite bearish on it at this time. But non-cyclical growth, I think that with the way this market's developing, the likely, we don't know what's going to happen. At least from my perspective, very well. Past 2024 at best. So, yeah, I think that staying with, staying with names that are going to drive price based on fundamentals versus sentiment, is going to serve investors well here in the cycle. So a couple reasons that should be cautious, I guess, on both information technology and energy in this case. But so this just shows the S&P 500 sector return relative to the index when there's a strong US dollar versus a weak US dollar. And that was identified by using a 1 year rolling Z-score for DXY, the US dollar currency index, above 1 strong, below 1 weak. So, we can see information technology does multiple times better um, from a weak US dollar, and energy actually underperforms when there's a strong US dollar, majorly outperforms with the weak dollar. Um, uh, not surprisingly, financials are, the opposite. A stronger US dollar tends to help, US financials. Obviously, so the one thing I was going to point out, to kind of, before I go to the next slide, communications. So they're negative for both times when the US dollar was strong and weak. So just to clarify, it's not all of the time between 1989 and 2024. It's specifically limited to times when DXY was identified as strong or weak. So Um, if there's anything to say for communications here, it's that I think that, like I said, healthcare kind of played that role of a great, non-cyclical growth segment for investors, in the late 2010s. And, communications hasn't performed to the level that it can and the level that we believe it will. So this is basically talking about a similar broader concept, which is how reliant S&P 500 fundamentals are on the United States economy versus international economies. So the S&P 500 has net revenue exposure in the US of under 60% and over 40% internationally. For infotech, it's almost 60% international and just over 40% in the United States. So, in this context, not related to a strong or weak dollar, but related to um, the health of these international markets that are driving a lot of the fundamental growth in US large cap stocks. So the most recent obvious example is Apple in China. They took and they're continuing to take a pretty big beating on it, but we think that there's definitely much more market risk in international economies than might be either priced in or talked about today. When you look at Japan, the longer term outlook with their debt problem, excuse me, currency problem, at the same time, their equity markets at all-time highs. Personal debt is an issue there. So there's quite a lot. It's not just China, but yeah. So as the sub line here indicates, we would have to see, even if a resilient U.S. economy is enough to hold up S&P 500 fundamentals, if this significant share of revenue exposure comes from international economies that we don't have, U.S. government doesn't has at best limited control of. So again, I think another risk that's underpriced in the market. So probably finishing out with the Russell 2000. So um, obviously I've heard a lot of people suggesting that, it's a great time to buy, valuations are low. Some people said they see as much as 75% upside or more at the end of the year. So here's the reality of the Russell 2000. It's extremely rate sensitive, more so than, those two large cap segments that I pointed out, utilities and staples. With the Russell 2000, well, two important things here. First, the Russell 2000 trades, very stringently on valuations and earnings actuals. There's no, at that market cap and etc. There's no, it's different this time story for investors to kind of, we hang their hat on, in a worst case scenario, or sorry, not in a worst case scenario, if they want to, to kind of excessively bullish position, if you will. So that's why they're more interest rate sensitive. But the second reason, so the way that monetary policy lag operates in with respect to US equity fundamentals, there's kind of a domino effect as to how a rate hiking cycle would adversely impact earnings for various equity markets. So it would start with small caps who have, little to no room to maneuver when suddenly costs, rose dramatically, and, all the other ills that, borrowing became almost impossible, et cetera, et cetera, demand depressed. So with the Russell 2000 and small caps, you'll start to see earnings decline immediately. There won't be like a 1.5 year lag period like we saw with large caps who benefit from economies of scale and, can do things like layoffs, forgoing investment projects to, the future when, the outlook's probably better. They were hit in the first quarter, after the Fed began to raise, and they've been taking, a beating in earnings wise ever since. So I thought this was really interesting. So today, 28% of the market cap of Russell 2000 growth is unprofitable today. During the peak of the 2008 GFC, 26% of Russell 2000 growth, 26% of the market cap of Russell 2000 growth was unpopular. So we've already surpassed the GFC by 2% in unprofitable market cap in Russell 2000 growth. And, again, I know I've said this many times, absent rate cuts, I am struggling to see the justification for why we should expect that trend to reverse. So I guess the bottom line is, again, I've heard the arguments for valuations. I myself am very much into buying low and selling high, but the timing has to make sense as well. You don't want to buy the Russell 2000 now when it's going to continue to get clobbered with higher for longer, and the risk of it really drawing down in a really severe way is, if we have a recession. So I would stay away from the Russell 2000 for now until actually the next slide will share more about that. But this slide shows the drawdown of the Russell 2000 relative to the Dow in today's cycle, and as well as the last four. So what this chart tells us is that this isn't even comparing to the S&P or the NASDAQ, but even for Dow Jones, value-oriented stocks, small caps tend to underperform drastically at the late parts of the cycle. So here you see Russell 2000 go down, Russell 2000 go down, and then conversely, it leads the new bull market. So we I would say it's maybe a little bit concerning that the current cycle trough appeared to be below the C19 pandemic trough, the GFC trough, in line with the early 90s recession, but only the tech bust was lower. So again, I don't love the current outlook for small caps while rates remain, an up in the air question. So I think, this could go further lower from here before we get to that recession. That's just another way to more easily show prior equity markets, like prior secular bull markets and equities, small caps take, leadership. Yells, the Russell 2000, and then the end of the cycle, you'll see large caps catch up or start to outperform. So, that's consistent with what I think we're seeing now. A late cycle equity rally, and I think it's unfortunately going to rally into economic disappointment, but that remains to be seen. So last slide. I feel like I spent a little bit too much time on this video as well, but hopefully this is an interesting one as well to close. I started with the yields curve. I'd figured I'd close with something interesting about the yields curve. So these bars represent the performance of dividend aristocrats relative to the S&P 500 at different yields curve moves, and this monthly data from 1990 to 2023. So as you could see, it highlights that bull steepening is typically associated with recessions and rate cutting cycles, while bear steepening commonly, gets misconstrued for a yields curve dangerously steepening into recession. It is still steepening, but there's an important distinction. So actually, in bear steepening, you could see the S&P 500 outperforms. So just to kind of give you a sense of how kind of knowing both the fixed income market and tying that into the equity market can give you powerful insights and also help you with your portfolio construction strategies. So in bull steepening, if dividend aristocrats are going to outperform the S&P 500 by 0.8% on a monthly basis, which is pretty strong. No, I think that's, like I said, that's helpful, and also gives a little bit of closure that the fixed income market and equity market aren't entirely naive about when we might start experiencing either systemic fragility or recession. So it's just the bottom line here is when we're getting closer and closer to recession, it makes sense to transition to value, more value oriented parts of the equity market. So that was all I had. Thanks a lot for anyone who watched, and have a great weekend.